think oil market is still chopping around $100, but the real price of oil just reaped to $150. Notice how Brent crude is still stuck between $100 and $106. Meanwhile, the Dubai almond physical benchmark just skyrocketed to $155. Anyone with half a brain knows this massive arbitrary gap is completely unsustainable. But hold your horses. Don't FOMO in just yet, because in the short term, we're staring down a massive pullback risk. Sure, we saw a violent pump yesterday afternoon that looked incredibly bullish, but if you market bought that with leverage, you probably got stopped out instantly. Why is this happening? First off, the market is completely desensitized to the geopolitical noise. When the news of Iran blocking the Strait first dropped, it was a macro nuke, but right now, the tab has fully priced in that bullish catalyst. Unless we use a severe escalation, like a full-blown regional war, there is simply no fresh liquidity left to beat oil higher. Just look at yesterday around 1 p.m. News broke that a US tanker got hit in the Gulf of Oman. Brent printed a massive intraday spike, but the pump lasted exactly 15 minutes. Before getting absolutely slammed by a massive wall of sell orders, looking at the EBC market buzz, the short-term sentiment on Brent has officially flipped bearish. The momentum is dead. This proves exactly what I'm saying. Geopolitical headlines have completely lost their juice in the short term. And on top of that, the oil market is severely overbought. Take Brent, for example. It violently ripped from $90 to $106 in just 2 weeks. That's a 15% plus pump. And after failing multiple daily breakouts, the chart is now printing a textbook bearish divergence at the top. $106 is a massive volume node and a historic macro top from 2022. It's loaded with institutional algorithmic sell orders. Looking at the EBC order flow, I'm seeing a massive sell wall right at this level. A short-term breakout is highly improbable. So that's my macro logic for a short-term pullback. But circling back to the intro, why are we seeing two completely different prices? And why am I still ultra bullish long term? JP Morgan nailed it. The current $106 is an Atlantic basin illusion. Once the US and European strategy reverse have drained, WTI will inevitably trigger a violent catch-up rally straight to $155. So in plain English, Brent pricing is currently dictated by Western demand. And because the West still has inventory, the price is artificially suppressed. But the Middle Eastern benchmarks reflect the Asian physical market. That is the true price of oil in a post-Strait blockade world. This massive arbitrary gap will inevitably be closed. But before that it comes, smart money has to do one thing first: flush the market. They're going to exploit the temporary lull in Asian demand to completely shake out all the brainless retail loans who'd FOMO'd in. So what's the playbook from here? Here's my macro projection. Market makers will likely use an upcoming macro event like the next Fed FOMC meeting to engineer a fake out to the upside. They will hunt the short seller stops and then aggressively dump it into a deep pullback. So listen up, guys. Over the next few days, if you are trading oil on leverage, do not blindly loan into resistance. The risk or reward is absolutely garbage. Even if we are heading into a macro super cycle, you have to survive this engineer shakeout first.